So good morning, guys, and welcome to our fourth session. This is going to be interesting session. Today is election day, so yeah, let's continue with our first half of fourth session. So we'll start with this beautiful quote, and we'll try to understand what that quote means. Price is what you pay, value is what we get. So for everything, right, when we purchase something, we pay certain price. We pay some money, right, worth its cost. But what actually that item or that particular thing could be different values for different people. Consider that you have purchased this training, you have paid some training fee for this course. Now this course may be very valuable for someone, and maybe of no value for someone, or could be like waste of time someone for someone, right? So that value will change based on your understanding how useful it is, how you utilize it. The same goes in the stock market. Okay, like in stock market you pay one certain amount, you pay a certain amount for particular stock. Okay, and some other person will think that this stock is not of that value, that's why he is selling, and you are thinking that this stock has much more value, it will grow further from here, that's why you are buying. Okay, so price is fixed for everyone, pay whatever price it is of a particular article or item, but value differ for each person. That's why we purchase or sell the stocks. If you think in terms of stock market, the person who is buying, he thinks that this value, particular value for the stock is much more, like no, it has much more worth. But the person who is selling, he is thinking that this stock is of not that worth or that much value, that's why he's selling. Okay, so with this we will understand more about the stock market and few of the things. The main thing we will going to understand is about quantity analysis of a stock, and quantity analysis is more fact based, number based, so it will be based on hard facts, and it will be the same for everyone. So to understand the quantity based analysis, we need to understand certain keywords or certain ratios, and what is that meaning of that particular ratio or value, right? Keyword, that is was, there will be some calculations, so I think we don't have to go much deep in the calculation how to calculate those values. More we will understand in terms like what is that, what is meaning of that particular keyword or ratio, and how we can utilize while analyzing the stock, what we should check. Okay, so coming to the first point, market cap. Market cap we have already seen, okay, in the previous session. Then we will see the dividend yield, intrinsic value, alpha and beta, EPS, PE ratio, PB ratio, ROE, ROC, DE, and this MA, RSI, and MACD we will not cover today. Okay. So let me, as I was telling, right, price and value example. With that, we'll start the intrinsic value. Okay. So what is intrinsic value? So intrinsic value is actual value of a stock, Say that one stock is trading at 30 rupees, and its intrinsic value is also 30 rupees. That means we'll say that stock is trading at a fair value. Suppose a stock intrinsic value is 60 rupees, sorry, 30 rupees, and it's trading in 60 rupees. That means it is overvalued. And if it is say trading below 30, that means it is undervalued. To understand, to give an example of intrinsic value, consider that there is one shop, and that shop is on the particular area, on land, and say that no, for some 1500 square feet land, and he has constructed no, one shop over there, and he has some material into this. Say that it's cloth shop, so he has some cloth over there. Say land value is say 50 lakhs. He has constructed some 25 lakhs worth no construction he has done, so became 75, and then he has put some employee and some material over there of 25 lakhs. So overall that shop value is actually he has put the money of worth 1 crore. So that is shop's net worth. From that shop, he will be getting some rent. Say he will be like, no, rent in the sense he will be getting the business out of it. So say consider, for example, every month he will be getting 10,000. Okay, profit, net profit. So in a year he will be getting 1,20,000 as a business. So 1 crore plus 1,20,000, that future value what it will be earning, right? Including that, we call it intrinsic value. So intrinsic value of that particular shop will be 1 crore 1 lakh 20,000, because we are no, considering the future growth of that particular shop, like future earning potential. So when we calculate intrinsic value for the uh, any stock, we consider future earning, future growth potential of that particular stock or company or business. Okay, so that is how we calculate. No, that is what we consider while calculating the intrinsic value. Now, how intrinsic values change? Why people buy for more than intrinsic value? Says that shop is now like 1 crore 1 lakh 22,000. That is its intrinsic value. Then why some people will buy that property for 2 crore, or why some people will be selling that property for less than 1 crore, even though its actual value is 1 crore? Consider that there is a news from some government or somebody, some resource, that near that shop, some road is going to come up. Big road is going to come. Say that as of now, that shop is in the remote area. Now, someone announced or somehow some news came out in the open market that near that shop or near that land, big main road is coming up. Suddenly, the price, all the price of land will shoot up, right? Right, you would have seen that land price, how land price increase if some road, main road is coming, or some shop is coming, big shop is coming. Those no nearby lands value goes up. Like same thing, like if airport, right, in Bangalore example, if you see that near airport, when they announce that airport is going to come up, suddenly all the land price has shot up. The same thing happens, and no, the actual price of stocks shoot up, and we buy it, people buy it at overvalue, or more than, oh no, overbought, ready to pay more than intrinsic value. Now consider that how, like no, how the intrinsic value goes down. Why someone will sell below the intrinsic value? Now consider that near that shop, whatever news has come, that no new road will be coming, that road will not be coming. That was fake news or false news, or government has changed the plan. Now government is planning to create some dumping zone nearby. So all the city garbage will come and they will dump the all the garbage near that shop. Some land they have allocated, government have allocated. Government plant has changed. Now what will happen? Suddenly the shop price will go down, right? Because no one will be coming there. That will be a stinking place and dirty place. So the people will not buy even that shop at 1 crore. So that is how stocks intrinsic value goes up or down. Now, if you consider right now, okay, in terms of stock market, we want to see that in all the IT stocks, right, has come down. They are trading much lower than their no normal or high or like no particular price. So this is the time you can invest in IT companies if you're looking long terms, because all the IT stocks are trading much lower than their actual price. Okay. So what has happened? Some other example I will show you of intrinsic value. During Corona time, all these airways, right, airlines, Jet Airways and our Indigo, their price has just come to the half, because business has stopped. So suddenly the stock price has gone down below their intrinsic value, and all the pharma companies price, right, share price has gone up from their intrinsic value, because of that medical test and the illness was spreading, that epidemic was spreading across the world. So all the pharma company and hospital stocks has gone shoot up, and it was trading much above than the intrinsic value. So hope you understand what is intrinsic value. And we don't have to calculate the intrinsic value. There are enough websites where you can find the intrinsic value. So consider that intrinsic value of any stock, say Wipro. Okay, let me see if it opens. So yeah, this I had opened. So he's asking me to create account and all. So I will go to some other site. Yes. So if you see, it's Wipro. I have opened the Wipro, and intrinsic value is, it is saying 30 September, based on 30 September, intrinsic value was 448 and market price was 406. So it was cheaper than the market price, right? And it's falling. So this is how this kind of opportunity we should take. I was saying all the IT stocks are near their intrinsic value or little bit above or little bit less around their intrinsic value. Okay, there are a lot of calculation how to do and all. We don't have to go that calculation, but you can, like in the website, you can see the intrinsic value. I can ping you this site so that later you can check. you just type any like stock name and intrinsic value, it will see. So let's say Infosys. So Infi intrinsic value they are saying around 898, and current market price is around 1435, and based on this September, okay, fairly bullish. It has started going up. So if you see, it is little higher than their uh, intrinsic value. Hold on. So intrinsic value we don't have to calculate. You can see in the different websites. So thing is, if you find any stock, other parameter, we don't have to take a decision only on the intrinsic value. But if you find some good fundamental stock below its intrinsic value because of some external reason, it's opportunity to buy the stock. The Corona time, all the aviation sector has fallen down, hotel industry has fallen down. So that was the opportunity to buy. Okay.
And sometimes it also happens that market price goes down and intrinsic price is more. That also
Yes.
happens.
Yes. So they consider that Corona time, right? During Corona time, all the aviation sector, hotel industry has fallen down, but all the pharma and hospital sector stock has gone up. So it has gone up above their intrinsic value. Right now, in current situation, right? If you see, pharma and IT company has most of the pharma and IT company has gone down. So many stocks are trading below their intrinsic value or around the intrinsic value. So this is time to buy IT stocks. But we do opposite. We sell IT stocks and buy some other stock. We run behind the stocks which are going fast. So I hope you understand the intrinsic value. Okay. Now let's come to our slide and see some more thing. Then market cap we have seen in the details, so we will not go in much details. I will tell you main thing, like market cap is actually net worth of the company, like net worth in the sense current market price into the number of shares. So suppose you want to acquire a company, how much money you need to pay, that is the market cap. Okay. And market cap varies based on the share price. Okay. Then dividend yield. We know last session we spoke about the dividend, right? Dividend is the portion of a profit which they give back to their shareholders. Companies give back to the shareholders. So say company make the profit and then they accumulate that profit, and they think that if the business we cannot deploy all this money, it's better to give some portion of profit to the shareholders. Now, how to calculate what is dividend yield? Dividend yield is the yearly how much company is giving the dividend. So, company can give a dividend in 1 year. They can give multiple times, 2 times, 3 times, 4 times. They can give. Okay. So, in a total year, in one financial year, how much dividend they have given, divided by their current share price, is called dividend yield, and we look it into the terms of percentage. So what percentage of current share price they are giving every year, the dividend yield. So what is formula for dividend yield is annual dividend per share, whatever times they have given 10 rupees, suppose they have given 3 times, then 30 rupees, or 4 times they have given 40 rupees. So total dividend yield, then current market price of that share, one share, okay, and multiplied by 100. So suppose one share, one company has given 7 rupees dividend, and you have 700 100 shares, then you will be getting 700 rupees is the dividend, right? Total dividend. And current share price is 100 rupees. So what will be your formula? Per share you are getting 7 rupees. Okay, not for like all the, so 7 divided by 100, then you will multiply by 100, then it becomes 7%. So company is giving 7% is a dividend yield. Okay. And this you can see in the any website. Okay, suppose let's say this is the one website. I will go select desktop, say Infosys. So this is all the parameter we see, right? So this is market cap, then number of shares, then there will be some dividend yield. This is the dividend yield. So company is giving, Infosys is giving 2%, around 2% as a dividend. So a lot of people who are investing in the market for dividend, they run their livelihood, or like they treat as a income source. So they look for the good dividend yield. So a lot of people invested in Vedanta, considering that Vedanta gives good dividend. Okay, the actual price of share, more than that they have got as a dividend. Hope you understand the dividend yield. Okay, so basically dividend yield is our yearly view of how much dividend we are getting compared to its share price. Okay, so investing in no high dividend stock is one strategy where people doesn't focus more on the share price, but they focus more on the dividend, how much they get. Okay, then intrinsic value we spoke already, right? Intrinsic value is actual value of, when I say that actual value, doesn't mean the only the what is current price, also we consider its earning potential. So intrinsic value in our example of that house, right, or that shop, was like land, construction cost, material cost, and employee cost, plus its earning potential of that shop is considered as a intrinsic value, not just the land, construction cost, and the material. Also, we have included the earning potential, that every month it will give me 10,000 as a rent, or like as a business profit. Okay. EPS is very important factor, and we should consider it, or we should understand it when no analyzing the stock. EPS means earning per share. So for say there is 100 shares, and that company is no earning 100 rupees profit. Okay, so per share how much they are earning? 1 rupee, right? So per share how much they are earning is called EPS, and it is important factor we will be using in other different ratios. So keep in mind. So net profit per share, how much you are getting for per share. Okay, then net, something like net profit divided by total number of share is called EPS. Okay, formula for calculating EPS is net income. This preferred dividend and all, for now you just ignore, because that is a special kind of dividend which is like goes through bond and all. So you consider net income and average number of shares, outstanding shares. So that is EPS. Okay, EPS you understand. In EPS you have any question? And EPS is directly related to your shares. Okay, number of shares in the market. So that is what we were talking about, buyback, right? So when we buy, companies buy back, what they do, they buy their own shares, and they destroy that number of shares. So if we buy back, number of shares will come down, and number of share will come down, then our EPS will increase. So basically you understand in this way. Suppose there is 100 shares in the market, and they are earning 100 rupees, and then they did the buyback, and they destroyed say 10 shares. Now that 100 rupees earning they will be getting, and that 100 rupees they will be dividing with 90 shares, right? 90 people. So each person will get more, so EPS will be increasing. So EPS, that's why they do the buyback sometimes to adjust this EPS and PE ratio.